Breaking news, as of November 16th, Fannie Mae removed the 620 minimum credit score requirement for mortgages. That's right, you no longer need a 620 score to be considered for certain home loans. But before you celebrate, here's what almost no one is explaining. According to Fannie Mae, the recent change was only to their mortgage underwriting guideline, removing the 620 requirement, but they still will assess your overall risk and your credit score still matters. Your interest rate, your mortgage payment, your mortgage insurance, and even how much you can borrow are still determined by your credit score. All lenders can keep their own minimums, so this change does not guarantee approval. Think of it like this. You can now walk through the door, but your credit score still decides the price you pay once you're inside. This doesn't just apply to mortgages. Your credit score also affects your credit cards, auto loans, and personal loans. So let's break down why your credit score still matters just as much, if not more than before. Let's start with what a credit score is. Credit score is based on a person's credit file using your social security number and how much debt you have. A credit score is also based on how well you manage credit over time. Credit can range from 300 to 850. A credit score of 300 is poor, whereas a credit score of 850 is excellent. If you want to buy a home, you will need a good credit score, even if you approved. Each month or every 30 days, your credit report is updated. So if you pay off debt that you incurred or added debt, the credit bureau will update your credit report every 30 days with any changes. You can achieve and maintain a good credit score by paying your bills on time, avoiding opening too many accounts, keeping your credit utilization low, and monitoring your credit report. The credit report also considers the length of time you have credit. Let me give you an example of credit utilization using a credit card. Even though I'm not a big fan of credit cards, I just want to illustrate the concept. Let's take scenario 1 and say you have a credit card with a $1,500 credit limit. If you carry a balance of $500 on the card, your credit utilization ratio would be 33%. 33% is above the recommended 30% threshold, which could negatively affect your credit score. However, in scenario 2, spending only $300 of the $1,500 will keep your credit utilization low at 20%. If you consistently keep your balance below that 30% mark, your credit score will improve over time, showing you're using credit responsibly and not overextending yourself financially. Simply put, your credit score impacts your ability to borrow money, such as a mortgage. A high credit score can lead to a better loan terms, including lower interest rates and higher credit limits, saving you a lot of money over time. For example, if you have a high credit score, you may qualify for a mortgage with a lower interest rate, saving you thousands of dollars in interest over the life of the loan. On the other hand, a poor credit score can make it harder to get approved for loans or credit cards. You might face higher interest rates if you qualify, meaning borrowing will cost you more. Beyond loans, your credit score can also affect things like renting an apartment or getting a job in some cases. In short, your credit score is tied to your financial reliability and impacts your ability to borrow throughout your lifetime. There are 3 major credit bureaus: Experian, Equifax, and TransUnion. You can check your credit score for free by visiting each credit bureau's website, which I will link below. If you enjoyed this video, please like and subscribe. It really helps with the algorithm. My name's Kelly, and I'll see you next time.